All right, and welcome to lesson 4 in this financial accounting series. We are up to completing the accounting cycle. The first 4 lessons are really the core concepts of this financial accounting series, and then once we get into later lessons, we just start to dig into more details. So this is definitely going to be a core lesson as we go through it right here. We are going to identify the steps in the accounting cycle, create an unadjusted trial balance from T accounts, determine the 4 types of adjusting journal entries, and prepare an adjusted trial balance and financial statements. At the end, we are going to complete closing entries. And really the rigorous part about this is going to be determining the 4 types of adjusting journal entries. So I wanted to start with an example here. This is Chipotle's balance sheet. Off to the right, Chipotle, as you can see, uses a calendar year end, December 31st, 2023. These amounts are in thousands, so Chipotle has $560 million of cash, as an example. And as we look at that, we're trying to understand which accounts require adjusting at the end of the period, where we need to look at them to figure out if we need to update revenue or expense items. So as an example, cash is not one that we do. Cash just is cash. But some of the ones that we're going to look at are going to be accounts receivable. We have to figure out if we've done any work for customers that we haven't billed for yet, or that maybe we or that maybe we did sell something on account and we got paid for and got to make sure we've recorded that. Prepaid expenses. Are there any expenses that we paid for in advance that now we've used up? Leasehold improvements, property and equipment. We're going to really focus on depreciation expense and kind of how our property and equipment is going to wear out over time. And then a bunch of accrued liabilities, accrued payroll. Are there any wages that we need to accrue for? Other accrued liabilities, that could be interest, that could be income taxes. And then unearned revenue. Is there any cash that we got in advance before we actually earned it, and maybe now we've earned it? So those are just some examples. Most of these balance sheet accounts you end up digging into a little bit to figure out if adjusting entries are warranted, but those are just a few of the big examples. So identify the steps in the accounting cycle. Well, we're going to prepare journal entries and post them to the T accounts. That's what we focused on in lessons 2 and 3. And then we're going to kind of pick it up here in lesson 4, where we're going to prepare an unadjusted trial balance, then make the adjusting entries. Again, that to me is one of the toughest parts of all financial accounting. Prepare an adjusted trial balance, prepare financial statements, close out revenues and expenses, and that'll give us a post-closing trial balance. So all of these certainly, take effort and time and everything, but it's, a lot of those last several can be automated. You're just kind of following a routine set of procedures, whereas adjusting entries, you really need to dig in to figure out what's going on with them. Well, review question number 1, which of these is not a step in the accounting cycle? Which one of these did we not just mention? Look at that for a sec. See what you got. All right. Well, it is not preparing a post-closing trial balance. That's the final step in the accounting cycle. It's not preparing financial statements. That's done after the adjusted trial balance has been prepared. It's not preparing journal entries. That's kind of like the first step, something that you're doing all throughout. It's closing out adjusting entries. We don't close out adjusting entries. We close out income statement accounts. So we close out revenue and expense accounts. So yes, there are adjusting entries. Yes, we do closing entries. Yes, we do closing. Well, we do close things out, but we don't per se close out adjusting entries. All right, create an unadjusted trial balance from T accounts. So there's frequently already going to be balances in the T accounts that we've done with our regular journal entries throughout the years. So we're basically going to sum those up and just use them to create an unadjusted trial balance. Some companies use debit and credit columns in this unadjusted trial balance. Others use a one-column approach where they have positive and negative numbers. And then accounts are generally going to be in the order they're going to be presented on the financial statement. So you're going to start with assets usually. You're going to start with cash, the most liquid assets, and then get into other current assets, long-term assets. Then you're going to get into current liabilities, then long-term liabilities, then then equity, then revenues, and then expenses. And when you do this, you need to make sure that debits equal credits. Certainly, if you have an automated system, that should happen automatically, but a general principle that needs to be followed. So let's say that these are T accounts. All right, I'm just kind of just have invented and say that this company has gone through the period. And at the end of the period, it had a variety of journal entries, and it summed these up, and these are the ending balances in T accounts. So they've got some assets, cash, accounts receivable, and prepaid rent. That's an asset. They've got some liabilities, unearned revenue, note payable. They've got equity and retained earnings. We're just going to pretend like they don't have any common stock for simplicity. They've got some revenues, and they've got some expenses. So what we do then is we create this unadjusted trial balance. So everything with a debit balance goes on the left, everything with a credit balance goes on the right. So you're going to see that we have 9 T accounts. There's just 9 account balances right here. And if they had a debit balance, we put it on the left, a credit balance, we put it on the right. At the end, they have to total up. One thing I mentioned is that some companies will show credits as negative, so they would just, the debit column would have been the same, and then these 4 credits, they just would have put them in that debit column. They wouldn't have labeled it debit anymore, but they would have put them in that column as negative, and then it all would have summed up to 0. That's a different approach, but this is what you're seeing right here is the approach we're going to use in this lesson. Right there, the one-column approach, okay? All the debits are positive numbers, the credits are negative numbers, it totals out to 0. All right. Well, what is a principle of creating an unadjusted trial balance? If you think of that quiz question, what are one of the things that we have to keep in mind? Look through those options, pause it for a sec if you want. Assets equal liabilities plus equity, debits are negative, net income is computed. Total debits should equal total credits, right? When we're doing an unadjusted trial balance, which one of these are we paying attention to? Well, it's not the first one. Okay, now that is true, but that's not the purpose of the unadjusted trial balance. Debits are not going to be negative. They're always going to be positive, whether or not you do that 2-column approach or the 1-column approach. We don't compute net income in the unadjusted trial balance. We could absolutely use it to compute net income, right? But we don't. Really the purpose is we just have all of our ending balances in our accounts, make sure that the total debits equal the total credits. All right, so that's the concept of why we go through that. Well, determining the 4 types of adjusting journal entries. We have accruals and deferrals for both revenues and expenses. So that means there's accrued revenue, accrued expenses, deferred revenue, deferred expenses. They fall in one of those 4 camps. Sounds easy enough, but a lot of these can be fairly challenging. You just got to dig in. So accrued revenue, this is when revenue is earned before the cash is received. Deferred revenue means that we got the cash before we earn the revenue. Accrued expense means that the expense was incurred before we paid the cash. And a deferred expense means that cash was paid before the expense was incurred. And a lot of these we actually did in lesson 3, but we just didn't label them necessarily like this. So we're going to go through it. Some of it will be repeating from lesson 3, but then to dig in more details and really label them as these 4 types of adjusting entries. Now, couple tips. When you are doing adjusted journal entries, cash is never going to be affected. All right, we're adjusting things where revenue and expense needs to be different. Okay, cash is never going to be affected. Each entry has to affect one income statement account and either an asset or liability. Usually I see adjusted entries are just 2, one debit and 1 credit. I suppose you could have more. But if you just think of the simplicity, 1 debit, 1 credit, one has to be a revenue and expense. The other has to be an asset or liability. If both of your accounts are revenue expense accounts, you're wrong. If both of your accounts are asset or liability accounts, you're wrong. If one of your accounts has cash, you're wrong. If you only have one account, you're wrong. If debits don't equal credits, you're wrong. All right, so just keep in mind these tips. So accrued revenue. So let's say a company provides $1,000 worth of services to a client during December, but doesn't invoice the client or receive payment until after the end of the year. Now, what the issue is you get to the end of the year. Adjusting entries are done at the end of the year. So you get to the end of the year, December 31st, let's just say, you prepare an unadjusted trial balance. You could do that January 1st, 2nd, 3rd, whatever you really want. And then there's a couple weeks span, depending upon the size of the company, where the accountants are really busy. You don't try to, corporate accountants right after the end of like the end of the year or a quarter, or sometimes the end of a month is not when you pester the accountants. That's when they're really busy making these adjustments. So they're running around the first couple weeks of January trying to figure out what to do. They're trying to say, okay, where have we performed services so that we should recognize revenue, but we haven't yet. All right. And the journal entries, when they identify where they've performed services but they haven't yet recorded revenue, they're going to do so by debiting accounts receivable and then crediting the revenue account. All right, so that is an adjusting entry that would be made by the accountants right after the end of the year. Sometimes this one actually happens when a bill is sent. All right, so you perform services as an example, and then you send a bill to the client. That might trigger this journal entry. But even if you haven't sent the client a bill yet, you need to make sure that this entry is completed so that revenue is included in the year when you perform the services. And then the following period, when you get paid, you're certainly going to increase cash, and that's when you get rid of the accounts receivable. You don't just wait until the next period when you get paid and do a simple debit to cash and a credit to revenue. It would be easier. Absolutely. It would be easier, but it's going to put the revenue in the wrong period. We want to put the revenue in the period in which it is earned. All right. So that's why we have this accounts receivable, which is kind of a temporary account. Deferred revenue. Okay, let's say a company received $1,000 from a client on December 1st for services to be performed later. So we know because the services are going to be performed later that when we actually do that journal entry, we're going to debit cash, but we can't credit revenue yet because we haven't done the services. So if you get cash before the revenue, we need to defer the revenue through the unearned revenue account. We covered that one in lesson 3. So we establish it, but then what happens is you get to the end of the period. Okay, and let's again pretend that this is a calendar year end. First couple of weeks, the accountants start digging into the unearned revenue account. They start reaching out to the sales teams, the production teams, whoever that is, and say, okay, did you actually perform these services? You know, sometimes the accountants might get notified automatically. Sometimes they might not, okay? Did you actually perform the services? And if you did, all right, then we're going to get rid of that liability because we've performed the services. We don't owe anyone services anymore, and now we're going to record that revenue. So in that situation, unearned revenue is the temporary account. So if we think about the 3 revenue examples before I move on, the first one just debited cash and credited revenue. That was the first example. That's like that's the base example. We didn't go through that, but when you get cash at the time of performing services, you just debit cash, credit service revenue. But under the accrual and the deferral examples, you set up a temporary account. Accrued revenue, you got the accounts receivable. Deferred revenue, you've got unearned revenue. You set up the temporary revenue account, and but then it comes and then it goes away. So at the end of the day, you still just have cash and revenues. But it's a timing issue. Accrued expense 1. All right, so this, in my opinion, is the toughest area, and there are just so many different type of expenses that you could accrue. This is where the accountants spend a lot of time each period. So let's say that a company pays employees $10,000 every 10 business days. At the end of the month, employees were owed for 7 days of work or $7,000. What are the journal entries? So what this means is they get paid every 2 weeks. So sometimes you reach December 31st and it's in the middle of that 2-week pay cycle. You don't pay them on December 31st. You wait and you pay them in early January. But because they've done some of the work, we owe them money as of December 31st, right? We owe them some money. It's just that we're not going to pay them for a few days, but we want to record that expense in the period where the activity incurred. We want to show that we owe them the money. So what do? You debit the wages expense for $7,000 and you credit the wages payable for $7,000. That's what you are doing at December 31st. Now, what happens then when the employees are paid next month? All right, the wages payable goes away to the tune of $7,000. It's not quite as simple as just saying you credit cash for $7,000. It's almost that simple, but the reality is now the employees are going to work the final 3 days, right? We pay them every 10 business days. We're going to assume they worked 7 in December, 3 in January. So we get rid of the payable in January of $7,000. Now they've worked 3 more days, so we owe them $3 more grand. We got to record that expense, and we credit cash for $10,000. At the end of the day, the wages payable account is gone. That $7,000 got credited, then debited, and at the end of the day, the wages expense totaled up to $10,000. $7,000 plus $3,000. Our cash payment totaled up to $10,000. But we don't just wait until January and then just record all the expense then. Why? Because some of the work was done in the previous period, in December as an example. So we want to record the expense when that work was done, when the activity happened that's causing that expense to be incurred. Another example here, a company takes out a 1-year $10,000 loan on December 1st. The loan has a 6% interest rate, and interest expense is due at the end of the loan. What are the journal entries? This one is one of the toughest ones in the entire first 4 lessons, in my opinion. The first one we're all okay with. Okay, so we've got a debit to cash and a credit to a notes payable. At the time that you do that entry, all we know is that we got some cash and we owe someone money. We don't care how long that loan was for. We don't care the interest rate. We're going to factor that in later. But at the time, as of December 1st, we just owe them $10,000. The theory is if we actually took out that loan on December 1st and we maybe decided we didn't need it, as an example, something changed like an hour later, we could probably go right back to the bank and pay it back. Okay, there might maybe a small fee for doing it, maybe not. All right. Well, what happens then on December 31st? No interest is due yet, but interest is accruing on the loan. So we want to record some now. The concept is principal times rate times time. Principal of $10,000, rate of 6%. The time, 1/12 of the year has passed. So $50 of interest expense is accrued, but we didn't pay it. So the offset to that expense is not a credit to cash, it's a credit to an interest payable. You think about that, because this loan has been outstanding for a month, this company owes some interest expense. It's not like they need to pay it yet, but the loan has been outstanding, so they are going to have to make a payment. They're not late on the payment, but they're going to have to make a payment in the future because this loan was outstanding for a month, so we want to record the expense in the period that it relates to. Now we get to December 1st of year 2. We get rid of the notes payable by debiting them. Most folks are okay with that. We get rid of that interest payable because we're going to pay it off. But then what happens is we have more interest expense because that $10,000 loan at a 6% interest rate was outstanding for 11 months in that second year, $550. The total cash is $10,600. So the loan of $10,000 had a 6% interest rate and was outstanding for a year. So that's $600 of total interest. That's why we borrowed $10,000 and repaid $10,600. That difference of $600 that we kind of lost in cash, that was our cost of borrowing the money, the $600 of interest. But we put the interest expense in the period it relates to, in the period when that loan was outstanding. All right. The deferred expense, and that's important because that'll impact the income statements, right? Well, it'll impact the balance sheet too, but it'll decrease net income in the period when that loan was outstanding. So deferred expense, the example here. Let's say that a company pays for 6 months of rent in advance. The total rent paid for the 6 months was $6,000 or $1,000 per month. What were the journal entries? Well, on December 1st, when it paid for the rent in advance, it doesn't debit an expense because it paid for rent in advance. It hasn't used it up yet. It certainly has to credit cash because we made a payment of $6,000, but the debit is to a prepaid expense. Now, when you see that word expense, most people are going to think that is an expense account on the income statement. It's not. All right. When the word prepaid is going to trump the word expense. When you see prepaid, it's an asset. Normally, when you see expense, it's an expense. But if you see prepaid and expense together, it's going to be an asset. So this could say prepaid rent expense, that's an asset. If it just said prepaid rent, it's an asset. If it said prepaid expense, it's an asset. If it just said rent expense and not the prepaid, then it's an expense. And that's what actually happens then at the end of December. So the accountants run around at the end of the month and they're like, okay, so we prepaid for some rent. Now it looks like we've used up a month of it. We've used up some of it. We've used up a month. Well, we got to record the expense. So $1,000 per month, we're going to record 10 grand of rent expense. That's going to hit the income statement. And then we have to show that the prepaid rent expense asset is going down. So that's a credit, should be indented a little bit there. And, the next year we would end up showing rent expense for $5,000 the other 5 months. And then we would credit prepaid rent expense for the other $5,000 next year. But we don't want to record all the expense when we paid for it up front to match the cash. That would be cash basis of accounting. We want to record it in the period when the activity is happening to cause us to have an expense. What is the activity? Not the cash payment, when we use the space. All right, review questions here. Wages earned by employees but not yet paid are which type of adjusting entry? So think about that one. And what do you think? All right. Well, it's not an accrued revenue because that's when you've earned revenues but haven't collected the cash. It's not a deferred expense. That's when you've paid cash, but the expense doesn't happen yet. It's not deferred revenue. That's when you got cash but didn't earn the revenue. This is an example of an accrued expense where an expense happened that you did not yet paid for. An expense happened, meaning you incurred it. In this situation, the employees did the work. Well, there's going to be a lot of adjusting entries for companies. A lot of them are going to be fairly complex. In several of the next lessons, we're actually going to go through examples of a lot of those adjusting journal entries as well. So you get through all those, and that can take time, all right? But then you get through all of those, and then to me, there's a variety of steps here, but they're very routine. You're just following formulas. And if you have a good computer system, it's just going to do this automatically. Create an adjusted trial balance and financial statements. So this is what your adjusted trial balance looks like. You remember your unadjusted trial balance had $74,000 of debits and credits? Well, what I just did is I took the 4 adjusting journal entries that we had and I put those into I put those 4 adjusting journal entries into the adjustment column. We can see that they total up to $10,050. We had the accounts receivable for work that we'd done that we hadn't paid for yet. We have wages payable. Accounts receivable work we did that we didn't collect on yet. Wages payable, right? That was employees that had worked for us that we hadn't paid. Unearned, we've got prepaid rent, right? So for rent that is getting used up. We've got interest expense. We've got the different type of adjusting entries that we went through. And then what we do is we create an adjusted trial balance. How this works is we just take our debits and adjust those by the debits and the credits in the adjustment columns. So for cash, there's never going to be any adjustments, so it stays the same at $28,000. But accounts receivable had a debit balance of $12,000, but we made an adjusting entry to increase it by $1,000, so then it goes up to $13,000. Prepaid rent was $6,000 of a debit, an adjusting entry to credit it for $1,000. So the net of a $6,000 debit and a $1,000 credit is a $5,000 debit. That's kind of how that's working. So each of the accounts has a debit or credit balance. and then we adjust those unadjusted amounts by the adjusted entries. I said the word adjust there a lot, and that gives us the adjusted trial balance. And you can see debits always equal credits at the bottom. And then we use the adjusted trial balance to prepare financial statements. We start with the income statement. All right, so I'm just starting here with my 38 grand of revenue, 24 grand of wages, 12 of rent, and then 50 of interest expense to get net income. We skipped taxes to make this one easy. We then go to the statement of retained earnings. So we had beginning retained earnings of 8 grand. We had net income of 1950, and then we had ending retained earnings of 9950. We then go to the balance sheet. We can see our ending balances for cash, accounts receivable, prepaid rent, wages, and so forth. But then retained earnings, we can't just take this 8 grand balance from the adjusted trial balance because we have increased it by net income for that period. And now we've got a balance sheet where the total assets of 46 grand equals the liabilities plus equity of 46 grand. So note that those 46 grands, that is not equal to like the unadjusted trial balance amounts or the adjustments or the adjusted trial balance amounts. And that's because this trial balance is a mix, not just of it's not just balance sheet accounts in there, right? It's a mix of income statement accounts in there as well. Review question number 4. In which order are financial statements prepared? So take a peek at that one. Which order did we just do that in? All right. We didn't do the balance sheet first, right? Because we need information from the other statements. We did do the income statement first, but we didn't do the balance sheet next. All right. We did not do the statement of retained earnings first because we needed to know what net income was. We started with the income statement to get net income. We fed that into the statement of retained earnings, and then we fed ending retained earnings into the balance sheet. Well, we've got most of it done. And then the closing entries, what we need to do is just prepare it for the next period. All right, we need to close certain accounts so that they may begin at 0 at the next period. Which accounts do we close out? It's the income statement accounts because they cover a period of time, whereas a balance sheet covers a point in time. And if I think about this, what it's like is, let's say that you have your local football team and they win their first game 28-17. Okay, first college football game of the year, they win 28-17. Your team does. What you do is you reset the scoreboard to 0 because it's not like the next game that you're going to see a 28-17 score on the scoreboard. So the scoreboard's kind of like an income statement for a period of time for one game. So you reset it to 0, but you also don't want to forget about the results of that game, right? Because you got to win. You won the game 28-17. So now you go to your, kind of the standings, and you show that you have 1 win and 0 losses. That's, kind of the standings are a point in time. The scoreboard is representing a period of time. Well, for the 2023 year, Chipotle had $9.9 billion of revenue, and at December 31st, 2023, they had $560 million of cash. So they're going to start the next year with no revenues, but the same $560 million of cash. So stuff like revenues gets reset. All revenues and expenses get reset. Day one of the next year, you don't have any revenues yet that year, but it's not like your cash went away. So that's another theory. So revenues, this is where we're going to debit them, and then we close them out with credits to retained earnings. Expenses in the closing entries is where we credit them and close them out via debits to retained earnings. It zeroes out basically net income because it zeroes out the revenues and expenses, and it moves it to retained earnings. So the example here, the sample company, 38 grand of revenue, wages of 24 grand, rent of 12 grand, interest of 50. So what happens is revenue normally has a credit balance. We debit it to get rid of it. And then but we don't just debit it and stop, right? It has to go somewhere. It goes into retained earnings with a credit to retained earnings. And then we close out the expenses. And when we close out the expenses, we credit the wages, we credit the rent, we credit the interest expense. This is one to me that it's a little bit easier to think of the credit first. So we get rid of the 24, the 12, and the 50, and then we sum them up and we reduce retained earnings by that amount, the 36,050. So if we look at what's happened here, The revenues and expenses are now at zero, and then the retained earnings, it got credited by 38 grand, debited by 36 grand and $50, so it went up by $1,950. All right, that was equal to net income for the period. And this gives you your post-closing trial balance. So again, yeah, retained earnings started at 8 grand, and then by virtue of these closing entries ended at 99.50. It went up by 19.50, which is net income. And net income does affect retained earnings. It does increase retained earnings. If it was a loss, it would then the closing entry debits would have been larger than the credits, and it would have decreased retained earnings. Balance sheet accounts, you don't see anything affected in the closing entries for the balance sheet accounts except retained earnings, and all the income statement accounts, they're at zero. Everything balances, and we're happy. The last review question: which of these accounts would not be impacted by closing entries? This doesn't say adjusting entries, but it says closing entries. Which of these would we never have a closing entry for? Okay. COGS is incorrect. We close them out to make COGS zero. Retained earnings, that's incorrect. We close out revenues and expenses with the offset going into retained earnings. Revenues is incorrect. We debit revenues in closing entries to make them equal to zero. We don't close out a balance sheet account like cash. Well, steps in the accounting cycle. We've learned in lessons 2 and 3 to prepare the journal entries. In lesson 4 here, we learned how to prepare an unadjusted trial balance and then make the adjusting entries, prepare an adjusted trial balance, prepare financial statements, close out revenues and expenses, and prepare a post-closing trial balance. And that'll be our trial balance for next period. And we learned about the 4 types of adjusting entries: accrued and deferred revenues, and accrued and deferred expenses. It's a lot. You're just going to have to end up practicing a lot as you go through this one in order to master the concepts in this chapter. Thanks, and we'll see you back for lesson 5.